Hello everyone and welcome to another special episode of the eToro Summer School. Today we are focusing on how does inflation affect the markets? So what is inflation? Well, we can simply define it as rising prices on goods and services across an economy over a period of time. The first thing I want to mention today is that inflation isn't all that bad. Central banks typically like to see inflation around 2%, which is a steady rise and indicates a healthy economy. Companies are producing, we see consumers buying, wages, employment, and businesses are all up, and this is good news. The second point is that when inflation does get significantly higher than 2%, it is a worry for investors. A significant rise in prices and goods will reduce the purchasing power of consumers. For example, if you have £1,000 in your bank account, but inflation is running at 8%, effectively that £1,000 can't get you the same amount of goods anymore. With inflation, you are effectively losing money. You probably noticed how things get more expensive over time. Well, for the most part, we can put that down to inflation. So who are the typical winners and losers during high inflationary periods? The losers column includes savers, as we have just mentioned. Exporters can struggle too as they become less competitive. For example, let's say in the UK that inflation is higher than other countries, our goods will become less competitive and exporters will see a decline in demand and therefore struggle to sell their goods. Also, borrowers on variable rates will struggle as well as workers on fixed incomes. From a market perspective, the economy in general will struggle as we go through a period of uncertainty. The more uncertain a period, the less confidence people have. They're less willing to invest. This can lead to less economic growth and less job availabilities, for example. When we talk about the winners, we can now introduce something called hedging. In periods where investors suspect inflation is going to be on the rise, what area may they choose to invest their money? What assets typically perform well? Gold has been long considered a good hedge. Certain commodities too, real estate investment trusts, and of course some stocks that are related to those we just mentioned. I think the main thing to point out is that there will be times in the market where we have high inflation, but gold, for example, doesn't perform that well. Equally, there will be times where other assets we just went through also struggle when, historically speaking, they do tend to fare well as hedges against inflation. So it is important for us to remember that it does depend on the circumstances we have inflation as to which assets will perform better or worse. If we are a super long-term investor, then it might not bother you too much if you're holding struggle over a short period of time. However, if you are someone who is looking to be more active in the markets and therefore more reactive to changes in the macro environment, you might want to have a playbook for each scenario. If inflation is on the rise, find out the reason why. Think what markets will struggle to push higher, and if you have any exposure to them, you can either take them off for a profit or loss, or just stop investing in them. Equally, you might want to invest in certain markets that will start to perform well. To keep it simple, it could be that you believe inflation is going to be on the rise, and you think central banks are going to raise interest rates to try and keep it under control. So you make the decision to invest in banks in the view that by raising interest rates, they will get more returns from lending. However, if inflation is out of control, banks will not perform as well as during a mildly inflationary period. If inflation is out of control, people can't afford what they could before. Demand is obviously going to fall and there is a lot of uncertainty, and maybe it would make more sense to invest in defensive stocks like consumer discretionary related companies. We previously mentioned commodities can be a good hedge against inflation. Due to their intrinsic value, commodities are thought of as a hedge against inflation and tend to perform well when consumer goods prices are rising, whereas equities tend to perform poorly when high inflation results in increases in interest rates, which tend to reduce the value of future cash flows for businesses due to the effects of inflation. Research by Vanguard points out that over the last decade, commodities rose by 7 to 9% for every 1% of unexpected inflation experienced by the economy. The low correlation that commodities often have to stocks and bonds may appeal to investors seeking diversification. This reasoning can be strengthened when inflation is on the rise, since investors may view commodities as a method to diversify their holdings. In summary, inflation essentially erodes consumer purchasing power, which in turn hurts earnings and forces a rise in interest rates and bond yields, which cuts valuations. This can then lead to a big economic slowdown or even a recession. The question of investors during this period is, how long will it last? People often refer to the lost decade of the 1970s, where central banks had little credibility. However, with more tools at their disposal, central banks can try now to react quicker to try and get inflation under control. Our last video that we focused on looked at how to invest during a recession. So do refer back to that for what areas of the market perform better or worse. Hopefully these videos have helped you map together how an economic cycle can work and how in certain periods, certain assets may perform better than others. As always, remember your why. Have patience if you're a longer term investor, be diversified, and be proactive if something significant changes. Inflation may sound scary after watching this, but just remember that typically the stock market returns are actually higher than inflation. From a US perspective, as we have mentioned previously, the stock market averages a 10% return, whereas inflation on average is just under 3% a year. Our next video is all about investing in the metaverse, a new and exciting industry, so do tune in. Until next time, I'm off to catch some sun rays. See you later.